Coming up on today's program, the International Energy Agency warns of record drops in energy investment. Administrators deny South African Airways is set to start flying. And Zimbabwe gold miners to keep more export earnings in dollars. Hello and welcome, and thank you for joining us on Business Incorporated. I'm Chimeze Obi Iwa. We'll begin the show with intraday market numbers from Africa, which were mostly positive, with the NSE gaining the most by 1.02% at intraday. Now, the main index in South Africa, JSE, gained 0.29%. Elsewhere in the region, Egypt's EGX 30 was unchanged at intraday. Kenya closed negative on Tuesday. And in the Middle East, the stock markets in the United Arab Emirates were higher at intraday, with Dubai leading the gains by 2.35%. On Monday, Crown Prince bin Mohammed said that Dubai will begin allowing free movement and business activity to resume today. The markets in Abu Dhabi rose 0.51%. Other major Middle Eastern markets, including Saudi Arabia and Qatar, remain closed for the Eid Fitr holiday. And European stocks were cautiously higher in early trade, with U.S.-China tensions capping market optimism over economic reopening. For more, here is Ulrich. Hello, Ulrich. Good afternoon. Well, the markets have had quite a good week so far. That goes for Europe as well. Now, today, the momentum seems gone. Are people just catching their breath, or they're just concerned? Perhaps is it concerns dampening the mood?
Yeah, I think they were catching their breath very clearly at the beginning of the day. You mentioned tensions between the United States and China, and that as a reason for less optimism. But then optimism started to kick back in, and the market gained ever more momentum as the day progressed, among others because hopes for a better development in the United States with the hope of reopening of business activity, and also hope of recovery of consumer demand, consumer spending. And so now when you look at the European markets, they're all up about as much as yesterday. The DAX going up by 2%, the FTSE 100 in London and the CAC 40 in Paris, they're also up by about 2%. The FTSE, actually, I have to correct myself, is up only 1.4%, but still a good margin over yesterday.
And the EU Commission President presented the EU's crisis program outlining aid it will give on the European level. Give us a summary of what it entails and how confident are market professionals that it will work.
Yeah, it's quite a comprehensive package, and the outcome is actually bigger than what was speculated on before it came out. It entails the European Recovery Plan alone, 750 billion euros that the European Union wants to borrow in the next years, and it wants to start repaying by 2027, and it will have repaid at the latest by 2058. And together with the next long-term budget, we're looking at EU funds of about 1.85 billion euros. Of this recovery program, the 750 billion, a big number, it's to be 500 billion in grants to the firms and about 250 billion in loans. I talked to one market observer, a seasoned economist, Carsten Jeske, chief economist of ING Bank here in Germany. He was positive on this news. He said it's helpful. It's also helpful that the package is bigger than what was speculated on before. That's helping. It's also helping to calm the financial markets. Indeed, I think that's also one of the reasons why the markets in Europe have picked up speed over the course of the day as news slowly started to trickle in that this was a big number that was coming from Brussels. Carsten Jeske also believes that it's good for solidarity in the EU, albeit all this, if one gets the program, he reminds everyone that it has to be a unanimous decision to kick this off, and there's a lot of debate at the moment on big numbers like this.
Now, focus today was on France's auto industry. Renault, Nissan, Mitsubishi is renewing its alliance and gave details today in a press conference. Now, the alliance has been rocked in recent times by the arrest in Japan of Carlos Ghosn. He was CEO at the time and the mastermind behind the alliance. Now, the world's third largest automaker is suffering from the effects of Corona. What did the Renault Nissan people have to say about how they are going forward?
I think the main message is that they're trying to take the tension out of the relationship between Renault and Nissan. That's always been speculated also on an instigator to the scandal around of Carlos Ghosn, his arrest, the possible background. And it was known that Carlos Ghosn at the time and the French government wanted Renault to take over Nissan completely, even though Nissan at that time was already being the more successful and more valuable company. Now, the Renault chairman, Monsieur Senard, says that they have no intention of taking over Nissan, and they're going to be, as a group, more efficient in the future. At least that's what they aim to do. They say that costs are, certain investment costs are going to be cut by 40%, and it will be a different company, Renault, Nissan, Mitsubishi, to take on certain lead roles on models. And they aim to make about half of the models from here on in developed by a single company in the group. That is Renault taking over light commercial vehicles, for example, and Nissan SUVs, which bring in a lot of money. The stock market reacted very positively to this. The Renault share is jumping ahead, accelerating, if you will, by about 16% today.
All right, thank you very much for your time, Ulrich. And in the UK, the FTSE 100 accelerated in morning trade. The gains looked to be fairly broad-based, with critical companies such as banks among the biggest risers. But let's see what has changed at intraday. Juliana Olainka will tell us. Hello, Juliana. Good afternoon. Well, the FTSE was on the rise in the morning. How much of that sentiment has been sustained at intraday, and who are the winners?
Good afternoon, Chimese. Well, it has sustained. In fact, there's a little bit of an uptick from the early trading results. At intraday, the FTSE All-Share is up 1.48%, the FTSE 100 up by 1.44%, and the FTSE 250, that domestic market, that's up by 1.70%. In the currencies market, the pound is down against the dollar by 0.01%, down against the euro by 0.31%, and up against the Japanese yen by 0.17%. One of the biggest risers on the FTSE at the moment is M&G, formerly known as Prudential UK. They're the massive insurer. Their shares jumped 9% after they did confirm that they will be paying out a dividend to shareholders to the tune of £410 million. There's no surprises why their shareholders were happy with that announcement. And also Auto Trader, their shares were up 3% as they confirmed that when their showroom does open on June the 1st, some vehicles will actually be having a 25% discount. So it might be a good time to get a new car from Auto Trader.
I can imagine. All right, now British Land, which owns a shopping centre, has written down the value of its retail portfolio by more than a quarter due to the impact of the coronavirus. What would this mean for UK property market?
Well, it's not great. British Land, they own a series of offices and also, as you said, a lot of department stores across the UK. They've just released their full year to end of March the 31st trading report, and they are down over £1.1 billion. But shareholders are still pretty happy with them because as soon as they released this trading report, their shares actually rose by about 3.9%. One of the major problems they've been having is, of course, the lack of people going onto the high street. Over the past couple of years, the British high street has really struggled because most people have preferred to purchase online, and those quiet high street stores are not cutting the mustard for some shoppers. And, of course, retailers have complained that the business rates that they're paying and the rents is just way too high. Then, of course, COVID-19 happened. And even though this year doesn't take into effect much of the lockdown, it does still account for a week of it, and that's really affected them. British Land have said that they've deferred payments of rent by more than £30 million. But as I said, you know, their shares were still up this morning, so they have counted this loss as, you know, the fall in the British High Street. But let's see what happens on June the 15th when we do start seeing those non-essential shops reopen again, and there could be a boost to their shares by that time.
We'll wait and see. Anyway, HMRC has detailed the number of self-employed people making claims for the Treasury's latest subsidy scheme. What are the details?
Yes, they have released this information. There are about 5 million self-employed individuals here in the UK. The self-employment scheme that the Chancellor kind of not begrudgingly, but it did take him quite a long time to agree to pay out this money. About 2.3 million self-employed people did receive this grant. Similar to what we saw with the furlough scheme, the government were basically subsidising how much they could have been earning during that time, to the tune of £2,500 a month. Now, really, what's been coming off the back of this data that HMRC released is a call from the creative industry for the Chancellor to extend those payments. It's due to end in a couple of days, but as we saw with the furlough scheme, which will be extended until October for those who are employed or in full-time employment, they also want that to happen. A lot of these self-employed individuals are hairdressers, they work in theatres, they work all over the creative showcase piece in the UK, and a lot of these places will not be open for a couple of months, or at least a couple of extended weeks. So yes, there have been calls for it to be extended. I think the last time I looked, there was a petition that had about 90,000 signatures. But yes, 2.3 million people have signed up to the scheme. And of course, the Treasury are worried that they just simply can't afford to do much more.
Well, let's continue to keep a track on those numbers. In the meantime, enjoy the rest of the day. And stocks in Asia Pacific were mixed today as investors weighed the potential impact of rising tensions between Washington and Beijing against the economy's reopening as coronavirus containment measures are eased. Mainland Chinese stocks were lower on the day, with the Shanghai Composite slipping 0.34%, while the Shenzhen Composite declining 0.85%. Hong Kong's Hang Seng Index dipped 0.71%. Elsewhere, the Nikkei 225 in Japan rose 0.7%. The Topix Index added 0.96%. In South Korea, the Kospi closed fractionally higher. Australia's S&P ASX 200 finished its trading day slightly lower. And U.S. stock futures pointed to more gains at Wednesday's opening. Optimism about the reopening of the economy and a potential coronavirus vaccine offset concerns about rising U.S.-China tensions. Recent hopes for a return to normal consumer habits have pushed the Dow Jones Industrial Average and S&P 500 to briefly touch key market levels for the first time since early March. Dow futures pointed to an implied open more than 300 points. The S&P 500 and Nasdaq futures also implied solid gains at the open. Stocks started the holiday-shortened week off strong on Tuesday. The Dow Jones Industrial Average climbed more than 500 points. The 30-stock average briefly traded above 25,000, a level not seen since early March. And the International Energy Agency has warned that the coronavirus crisis is causing the biggest fall in global energy investment in history. Before the pandemic, funding was set to rise 2%, but now it's predicted to plunge 20%. Fossil fuels are hit hardest, with a 30% funding drop expected for oil and a 15% fall for coal. Renewable investment is down 10%, and it's only about half what's needed to combat climate change. Due to coronavirus lockdown measures imposed by many countries for the time being, the fall in investment is leading to a drop in planet heating carbon emissions. But the IEA warns that the use of fossil fuels is likely to rebound when the crisis is over, leading to a spike in carbon monoxide. Meanwhile, oil prices fell in early trade on revived concerns over how quickly fuel demand will recover, even as coronavirus lockdowns begin to ease in many countries, while U.S.-China tensions added to negative sentiment. Brent crude futures fell 21 cents to $35.96. U.S. West Texas Intermediate crude futures were down 31 cents at $34.04 a barrel. The Organization of the Petroleum Exporting Countries and Producers, including Russia, a grouping referred to as OPEC+, are cutting their output by nearly 10 million barrels per day in May to June to buttress prices as measures to rein in the coronavirus pandemic have slashed fuel demand. We'll take a break, and when we come back, we'll bring you all the news across Africa. Do stay with us. Yesterday, the National Bureau of Statistics released the report on capital importation into Nigeria, and that showed an increase of 53.97% compared to the fourth quarter of 2019 at $5.9 billion. Now, the report came as a surprise to many, as the expectation was that the figure would drop considering the effect of the coronavirus pandemic, but that did not happen. Let's get the perspective of frontier market analysts at Docker Frontier London. I'm being joined by Matt Kiniger, a senior analyst for Sub-Saharan Africa. Hello, Matt. Good afternoon. Thank you for joining us.
Hello, good afternoon. Thank you for having me.
So what are the trends in the first quarter capital importation data that stand out for you?
It is interesting to see that there was quite an increase in capital importation in Q1 compared to Q4 last year. But I would note that on a year-on-year basis, so comparing Q1 2020 to Q1 2019, there actually has been a decline in capital importation in dollar terms. So there's around about a 30% decline. So that is a little bit worrying. Another key trend, which is not surprising, is that Lagos has been the main recipient of capital importation. This is, as I say, not surprising given Lagos's status as the commercial and financial services hub of Nigeria. But crucially, one of the major trends that stood out for me is the fact that foreign direct investment into companies in Nigeria has been or continues to be very weak. The country has experienced a number of years of weak foreign direct investment levels. And so this is a bit of a concern for infrastructure projects and the development of productive sectors such as agriculture and manufacturing that the government is very enthusiastic about supporting.
Now, portfolio investment is doing relatively well, but why has Nigeria struggled with weak foreign direct investment levels in recent years, despite generous government incentives? I mean, looking at the country from the outside.
Yeah. Yes, that's right. So it's really interesting to compare Nigeria to other markets in the region. So we've noted recently that Ghana has actually overtaken Nigeria in terms of foreign direct investment inflows into the country. And bear in mind that Nigeria's economy is several times larger than Ghana's. So that is obviously a trend that we've been monitoring very carefully. So Nigeria does have a number of investor-friendly laws. It has quite an open investor legal framework. And the government has introduced a number of incentives in recent years to encourage more foreign direct investment into productive sectors like agriculture and manufacturing. But the main reason that investors haven't been that forthcoming is that a number of factors have disincentivized them. So, for example, Nigeria has experienced a number of years of weak economic growth. Compared to the 2010s, Nigeria's growth has not been very high in recent years. There have also been concerns around chronic foreign currency shortages. Most companies I speak to are quite concerned when they invest into Nigeria. The country's experience with foreign currency shortages, they're a bit worried they won't be able to repatriate their earnings. And also there's ongoing concerns around operational difficulties, especially outside the sort of main urban areas. So issues around infrastructure quality, access to electricity. So these do create concerns for companies that are looking to invest into Nigeria.
All right, Matt, a quick one before I let you go. How will the recent exchange rate reform in Nigeria affect the outlook for foreign direct investment?
Yeah, so this is actually a very positive development. And this is primarily because it will, in our view, at Docker Frontier, result in improved access to foreign currency in Nigeria over the longer term. And this is because the exchange rate will be much more flexible and much more adaptable to market trends. However, we don't expect there to be a significant improvement in foreign direct investment, at least before the end of the year. And this is for two reasons. One is that Nigeria's economy is likely to fall into recession this year. So investors will be quite cautious about investing, but also a lot of, a very weak economic environment globally, North America, Europe, and in Asian markets. Weak economic trends in those regions will mean that investors will also want to be as risk averse as possible for the next 6 months or so. So we'll have to look to 2021 before we start to see an uptick in foreign direct investment in Nigeria.
All right, thank you very much for your time, Matt. Matt Kiniga is a senior analyst for Sub-Saharan Africa at Docker Frontier. And Moody's has maintained its negative outlook for Nigeria's banking system due to what it described as weakening loan quality and foreign currency liquidity. Joining me now is the banking analyst at Moody's, Peter Mushangwe. Hello, Peter. Good afternoon. Thank you for joining us.
Good afternoon. Thank you for having me, and good afternoon to listeners.
Yeah, you talked about the significant weakening in loan quality and foreign currency liquidity in your negative outlook for the bank. Can you give us an overview of key drivers of the negative banking system outlook?
Yes. Our negative outlook reflects three main risks for Nigerian banks. Firstly, higher non-performing loans due to the impact of low oil prices and the coronavirus pandemic, which will disrupt economic activity in Nigeria. We expect Nigeria's economy to contract by 3.1% this year, and banks' non-performing loans to double to between 12 and 15% of gross loans. The second factor is the higher foreign currency funding risks for Nigerian banks due to the lower oil prices and lower remittances. This will reduce the stock of foreign currency inflows into the system. The Nigerian banks have about 40% of their loans in foreign currency, and as a result of that, they do need foreign currency funding to support these assets. Lastly, the other risk we see is a substantial deterioration in banks' profitability. We expect the banks' revenue to slow down due to the coronavirus disruption and lower yields from government securities, while on the other hand, loan losses will increase. As a result, we do expect banks' return on assets to fall to lower than 1% from 2.5% in 2019.
All right,
so
all right, Peter.
Our key drivers for the negative outlook.
All right, Peter, we really don't have much time, but a quick one before I let you go. You noted that the largest banks still benefit from a high probability of government support if required. What are you trying to say here? And are we likely to see more consolidation going forward?
Yes, we assume a high probability of government support for large Nigerian banks because of their importance in the payment system and their invaluable role in intermediation. We also believe that despite the low oil prices and slow economic growth, which will strain Nigeria's revenues, the amount of banking assets in the system is still low at just about 30% of GDP. So this enhances the capacity of the authorities to bail out banks. In addition, Nigerian authorities have historically shown strong willingness to support struggling banks, as indicated by the previous bailouts. So we do see high probability of support for large Nigerian banks.
All right. Thank you very much for your time, Peter. Peter Mushangwe is a banking analyst at Moody's. Well, it's in that note that we draw the curtain on today's edition of the program. Thank you for watching. I'm Chimeze Obi Iwagu.